What if the next global crisis doesn't begin with a missile strike, but with your grocery bill? What if the real battlefield between Iran and the United States? Isn't in the skies over the Middle East, but inside oil markets, bond yields, and the strength of the US dollar. When tensions rise between Washington and Tehran, headlines focus on military maneuvers, air defenses, naval deployments, and political speeches. But beneath those headlines, something deeper begins to move. Energy markets shift. Investors reposition. Currencies react. Supply chains adjust. Insurance premiums climb. And quietly, the global economy absorbs the first shockwave. Every serious economic confrontation involving Iran eventually circles back to one critical location: the Strait of Hormuz. This narrow waterway, just a few miles wide at its tightest navigational points, carries roughly 1/5 of the world's traded oil. Tankers transporting crude from Saudi Arabia, the United Arab Emirates, Kuwait, Iraq, and Iran pass through this corridor on their way to global markets. It is not just a regional shipping lane. It is one of the most important economic arteries on the planet. If tensions escalate in that region, oil markets do not wait for confirmation of disruption. They react to risk. Traders price impossibility. Insurance companies raise premiums. Shipping companies reconsider routes. Even rumors can send futures contracts climbing. And oil does not need to stop flowing for prices to surge. It only needs to become uncertain. Higher oil prices ripple outward almost immediately. Gasoline becomes more expensive. Diesel costs increase. Airlines adjust ticket prices. Shipping companies pass costs to retailers. Food transportation becomes more expensive. Manufacturing input costs rise. Inflationary pressure builds. For American households, the effect shows up at the pump first. But it doesn't stay there. Energy is embedded in nearly every part of modern economic activity. Yet the situation is not as simple as Iran blocks oil. Prices skyrocket. Iran itself depends heavily on energy exports. A full closure of the strait would damage its own economy. That reality introduces a complex layer of strategic calculation. The true leverage often lies not in actual disruption, but in perceived threat. Markets respond to fear more quickly than to facts. A credible threat can move billions of dollars before a single ship changes course. This is where economics becomes inseparable from geopolitics. Military power may deter aggression, but economic leverage shapes behavior over time. Energy choke points, sanctions, trade routes, and currency systems function as pressure points within a much larger network. When geopolitical tension increases, financial markets shift into what professionals call a risk-off environment. Investors reduce exposure to high-growth equities. Volatility rises. Capital flows toward perceived safety. Historically, that has meant increased demand for U.S. Treasury bonds and, often, a stronger U.S. dollar. Gold sometimes rises as well, though not always immediately. The pattern is psychological as much as financial. Investors seek stability when uncertainty expands. However, markets are forward-looking mechanisms. They do not price today's headlines. They price expectations about tomorrow. If investors believe escalation will remain limited, markets may dip briefly and recover. If they anticipate prolonged instability or regional spillover, defensive positioning intensifies. Duration becomes the central variable. A short flare-up is absorbed. A prolonged standoff begins to test systemic resilience. Here emerges one of the most fascinating paradoxes of modern geopolitics. When instability connects to the United States, one might expect the dollar to weaken. Yet historically, global crises often strengthen the dollar. The reason lies in the structure of the international financial system. The US dollar remains the world's primary reserve currency. Central banks hold vast reserves in dollar-denominated assets. Global trade contracts are frequently settled in dollars. The US Treasury market is the deepest and most liquid sovereign bond market in the world. During periods of stress, capital flows toward liquidity and perceived institutional strength. Even countries that politically oppose American foreign policy still rely on dollar-based systems for trade and finance. This creates a powerful feedback loop. Turbulence drives demand for dollars, which reinforces the dollar's central role. Yet this dominance also generates tension. Sanctions policy, financial restrictions, and control over payment infrastructure have become tools of geopolitical influence. Limiting access to dollar clearing systems can significantly constrain a nation's economic activity. Financial restrictions can isolate banking sectors. These measures are quieter than military action, but often more disruptive in the long term. The use of sanctions as a strategic instrument raises an important question. Does repeated reliance on dollar-based leverage encourage other nations to seek alternatives? Some countries have explored bilateral trade agreements denominated in non-dollar currencies. Others have increased gold reserves. Discussions about financial multipolarity have grown louder. None of these efforts have yet displaced the dollar's dominance, but the conversation itself signals a long-term shift in strategic thinking. Gold, historically, represents a hedge against systemic instability. It carries no counterparty risk. It is not tied to the creditworthiness of a single government. In times of deep uncertainty, investors often allocate capital toward precious metals. Yet gold's behavior can be complex. When liquidity tightens sharply, even gold can experience temporary declines as investors sell assets to meet margin calls over longer periods of sustained uncertainty. However, gold often regains appeal. Digital assets add another layer to the modern financial landscape. Some investors describe Bitcoin as digital gold, citing its fixed supply structure. Others emphasize its volatility and dependence on liquidity conditions. In severe crises, assets that rely on speculative capital can swing dramatically. The defining factor becomes access to cash, not ideological alignment with a monetary philosophy. While major economies reposition capital strategically, emerging markets face a more immediate challenge. When oil prices rise and the dollar strengthens simultaneously, developing nations experience compounded pressure. Energy import costs increase. Local currencies may weaken. Debt servicing obligations, particularly if denominated in dollars, become more expensive. Inflation accelerates. Governments confront difficult fiscal trade-offs between subsidy support and budget stability. The social consequences of these pressures can be profound. Economic strain can fuel political unrest. Currency instability can erode purchasing power rapidly. Fiscal deficits can widen for nations without deep capital markets or strong reserve buffers. Sustained geopolitical tension elsewhere can trigger domestic instability at home. In this way, economic shockwaves extend far beyond the original conflict zone. Modern conflict, therefore, rarely unfolds solely through military confrontation. Financial systems, supply chains, energy networks, and currency regimes form an interconnected web. Pressure applied in one node reverberates across the system. Sanctions reshape trade routes. Energy constraints alter inflation trajectories. Currency fluctuations influence capital allocation. The question becomes whether the global economic system is resilient enough to absorb prolonged geopolitical friction. In the past 2 decades, the world has endured the global financial crisis, pandemic disruptions, supply chain breakdowns, and regional wars. Each event stressed the system in unique ways. Recovery followed, but not without structural adjustments. Resilience depends on diversification, liquidity, depth, institutional trust, and coordination among major economies. If energy markets remain functional and financial channels stay open, volatility can be contained. If fragmentation accelerates, parallel systems may develop, reducing efficiency and increasing transaction costs globally. The Iran-US dynamic represents more than a bilateral dispute. It intersects with global energy distribution, reserve currency, architecture, and strategic alliances. Military escalation would have immediate consequences. But even absent direct confrontation, economic maneuvering continues beneath the surface. For American households, the most visible indicators may be gas prices and inflation data. For investors, the signals appear in bond yields, currency indices, and commodity charts. For policymakers, the focus centers on maintaining stability while preserving strategic leverage. The true battlefield may not produce dramatic images. It may not dominate television screens daily, but it operates continuously through markets and institutions. Economic power shapes outcomes slowly, persistently, and often invisibly. If tensions ease, markets recalibrate. Risk premiums decline. Oil stabilizes. Capital rotates back into growth sectors. If tensions intensify, volatility expands. Defensive positioning strengthens. Structural questions about the international financial order grow louder. The global economy has endured oil shocks before. It has navigated geopolitical rivalries before. Yet each era carries unique structural conditions. Today's world is more interconnected than ever. Supply chains stretch across continents. Financial transactions clear in milliseconds. Capital flows respond instantly to headlines. In such an environment, localized conflict can generate global consequences with unprecedented speed. The resilience of the system depends not only on military deterrence, but on economic coordination and institutional credibility. The deeper question is not simply whether conflict escalates. It is whether sustained geopolitical tension accelerates a gradual transformation of the global financial architecture. If alternative settlement systems expand, if reserve allocations diversify meaningfully, if energy trade fragments along political lines, change rarely occurs overnight. It unfolds through incremental adjustments. Policy decisions accumulate, incentives shift. Over time, structural realignments emerge. For now, the dollar remains dominant. Energy markets continue functioning. Financial institutions operate, but strategic pressure tests boundaries continuously. The economic war behind the headlines is subtle, complex, and ongoing. It does not require battlefield images to shape outcomes. It moves through risk premiums, currency valuations, and capital allocation. The next time headlines mention rising tensions between Iran and the United States, the most important developments may not be visible in the sky. They may be visible in oil futures, treasury yields, and the strength of the dollar, and ultimately, in the purchasing power of households far removed from the conflict itself. That is the hidden dimension of modern power. Not just force, but finance. Not just territory, but trust. And in a globally integrated system, trust is the most valuable currency of all.